We are excited to start the Wyckoff Trading Course Part 1. We're starting the fall semester. As usual, everything that we discuss is for educational purposes. Stop the recording and read the disclaimer in full. All right, let's talk about the course a little bit. First of all, if you have any questions, contact Nancy at info@wyckoffanalytics.com. There are 15 sessions. You see all of the dates right here. The very common question, I am in a different time zone. I cannot attend when you have a live class. Could I just attend the classes on demand? Absolutely. And in fact, the majority of our students attend on demand. And a smaller group of students usually attend live classes because they are somewhere close, like in the US. And that's totally fine, as long as you have the ability to watch the recording after it's been posted to our website, to your student profile page, and you do your homeworks. Of course, I understand the circumstances for different people are different, and most definitely, some people are going to be more involved in the course, some people are going to be less involved in the course. Whatever you do, I promise you that even if you are an observer, you're going to get a lot of material, and your understanding of the markets and how to read the chart will improve dramatically. But at the same time, if you are the person who's going to tell me like, okay, Ramon, why don't you push me? I need that push where I'm going to do all of the homeworks. I'm going to be interactive with you during the sessions. I'm going to, devote as much energy and time to this material. I want to improve as much as I can. I'm definitely going to push you. I'm that type of teacher that loves those type of situations. I love to see the improvement. I love to figure things out, what's working, what's not working. So just let me know. Okay, time. We usually conduct the sessions between 3 to 5:30 Pacific time. Occasionally, I might have some personal issues and I might say like, okay, let's move it by 30 minutes or something like this, but it happens very, very rarely. By the way, all of the homeworks should be submitted, one file per homework, right? So I don't want to see any zip files where I need to, have multiple files to be opened. I don't want multiple files in your emails. Please just send it and combine everything into the PowerPoint, PDF, or Word doc. And also, because we receive quite a lot of emails, I would prefer if you guys title your emails in a specific way, especially if it's a homework. So put your first name, the first letter of the last name, the course, and the homework number. So that would be the best. And you also could use our other email address, wyckofassociates@gmail.com. Another announcement, which is a very common question for this session, is this session being recorded? Yes, indeed, it's being recorded. Will it be posted somewhere? Yes, we will post it tonight on our YouTube channel, which is called Wyckoff Trading Method. So catch it there. Another quick announcement here is about the pricing. So for those of you who have taken this course, WTC alumni, so that's a $700 for you. We want you to come back because we know how much information I give you during those sessions. So if you feel like it's better to retake it, that's totally fine. But also, with the full price at $998, so that's a $300 discount right there. But I really like this option, and it's very popular with students. So 4 recurring payments as of today, going forward, $249 per month, $250, and just for 4 nines, those are the much easier payments. Some questions. Are the handouts available to follow along? Dominic is asking. First of all of our slides for each session, all of our homeworks, and videos for the class will be posted in the student profile page. Those of you who already signed up for our course, you already have the access to that. For those of you who's going to sign up tonight or maybe tomorrow morning, you guys will receive the access immediately. And there you will see, first of all, your homework. That's going to be Jim Fortes' article, Anatomy of the Trading Range, for you to read for next week. And this is where we will be posting everything. Now, do I give the handouts before the class? No, this is not my style, my teaching style, to give you the handouts before. Why? Because I know the nature of a human being. It's a curiosity. You will be going through all of the slides before I even talk about those. And some of them will include some assignments and some solutions. So I don't want to give you something that your mind will be distracted. Okay, Paul J is asking, hi Ramon, I'm in Luxembourg, but we'll be doing the live course. We'll just drink lots of coffee. Okay, so that's just a comment. Okay, Paul, welcome to the course. Yes, we have quite a few students that are in Middle East, in Asia, in Europe, in Latin America, and yet a lot of them, even in those time zones, especially like Asia, Middle East, Europe, they come to the live session just because they want to participate in the session. They want to ask questions as we unveil the material. So great, let's do exactly that. And I'm all for it. Get some coffee, get comfortable, and let's work. All right. I'm gonna go today through a slightly unusual format. I'm going to be throughout the whole session I'm going to be having a Q&A session with you guys. And those are the most common questions that people ask me, just because, you know, they come to me and they say like, okay, well, you're an expert. Can you answer me this question? So all of these questions is something that you usually ask me or someone else in my position. So the first two questions: what is the Wyckoff method? Is this a technical analysis? It's a part of technical analysis. It's a technical analysis methodology. It's a method that is based on the principles of technical analysis. And the most important principles is the identification of the dominant force. It's either supply or selling. It's either selling or buying, and its effects on the price. So we're going to be discussing, how do we see that selling? How do we see the buying on the chart? And because of that, how does the price structure unfold, whether in the trading range or whether in some kind of trend? And that's all behind the activities of institutional investors and traders. So that's going to be our, almost like subliminal bias to always go to the institutional behaviors as to why the price structure is being created the way that it does. And that's a very, very important definition, heuristic definition for us. Does the Wyckoff method work? Well, I'm sure that a lot of you already using this methodology. And if you use this methodology and you've been doing this for years, that probably tells me that it does work. It definitely works for me. It definitely works for majority of our students. I can't say that it's the methodology for everyone. You kind of have to feel connected. You have to be like, a little bit of a chart nerd in what sense? In the sense that you'll have to spend a lot of time with charts. You'll have to study them. You'll have to practice with charts. You'll have to trade off the charts. And with that, the major obstacle that I see for students or traders that are trying, to go into the Wyckoff methodology is just the ability of a trader to practice countless hours developing the proficiency. But what craft doesn't require that? I mean, like, if you really want to make money, and making money in trading, unfortunately, is not a salary. Making money in trading is always the high peak performance, and then the effects of being kind of like lower than your optimal level of execution. So with that, you have to practice so much so that during the, let's say, US session or whatever you trade, you can come and perform at a very high level. Wyckoff method also works in multiple markets, whether it's an equity, cryptos, futures, forex. You could also apply Wyckoff method in different time frames: intraday, daily, weekly, monthly, because it's all about the price structure and the dominant force. All right, let's talk about the curriculum for this class. As I already mentioned multiple times, price structural analysis is going to be extremely important subject for us to discuss. And where do we start on this subject? Change of character and change of behavior. we're going to be figuring out how is it from the trending environment, we go into non-trending environment, and then we go to the trending environment. That could be a different schematic, right? But what we are going to be interested in is those places where that change takes place, right? So I'm going to give you some beliefs about the markets that are Wyckoffian beliefs and that are my personal beliefs, and it will help you out to kind of restructure your thinking about the market and how you actually analyze the chart. So when we think in the way of like, okay, where is change takes place and how does it look, then it becomes a little bit easier endeavor for us to go through all of this material. So we're going to study those behavioral changes that lead to the price environmental changes. And that we will do through character in the result concepts, but also we'll talk about Wyckoff events and Wyckoff phases. Those are highly misunderstood. I mean, like, it's only because I've been studying this and I've been teaching this and I've been trading Wyckoff method for almost 3 decades now. I have a slightly different conception or preconception about Wyckoff events and Wyckoff phases, and especially Wyckoff schematics. How many people are making that mistake that they look at the schematic and the price has to do exactly the same thing as the schematic? Not true. So we'll talk a lot about that. But Wyckoff events and Wyckoff phases are going to be extremely important events for us and concepts to recognize the timing of where we are in the trading range. Then we'll talk about probably the most important subject. Now that you're going to have some kind of, background, very solid background into the price structure, and we'll be practicing. I'll be giving you a lot of homeworks on price structural analysis. Then we're going to talk about what is the dominant force on the chart and currently, because that force could change. So I'm going to show you and I'm going to teach you how to observe the changes in the dominant force and what it does to the price structure. And then from there, we're going to make some conclusions, deductions as to what is the most probable, not in a predictive way, but in terms of like, okay, probabilities. You have a high probability of the continuation, or you have a high probability of some kind of reversal. And that's all behind the volume and price analysis. The most important law in Wyckoff methodology is the law of effort versus result, not supply and demand. Supply and demand law actually is being almost inserted into the effort versus result. Effort versus result is the law about harmony and disharmony, and that's how we use this. And by the way, this is a very common technical analysis concept as well. The divergence, the disharmony between, let's say, some kind of like momentum concept and what the price is doing. We'll talk about the bar by bar analysis. I'm going to show you a lot of the proprietary stuff that I've developed for myself, for our students, for institutional clients, swing by swing analysis and historical analog. So this is going to be an extremely important about 2 months, 2.5 months of studying. Then we're going to talk about relative and comparative analysis. I know a lot of you know this material, but I'm going to give you a lot of the proprietary techniques there as well. Plus, we need a really great foundation to move forward. And after that, we'll talk about trade management. Where do we open the position? Where do we put the stop loss? How do we move the stop loss? Where do we add? How do we trim? Where do we exit? What's the size should be? How do we deal with the trending trades? How do we deal with the counter trending trades? And so on and so forth. And the last session is always devoted to the Q&A. That's the curriculum of WTC1. I also want to invite you to tomorrow's session. Tomorrow is also open door session for our second flagship course, which is the continuation of the WTC1, the one that you are taking now, WTC2. So at the same time, 3 p.m. Pacific, come to the open door session. Would love to have you there. If you can't make it, again, just register. We'll send you the link, on-demand link. What are the main topics and exercises that we cover in WTC2? Significant bar analysis. This is more advanced version of the VSA. Swing analysis. This is just our kind of like swing analysis on drugs. This is where we are applying different methodologies, including and most definitely the cumulative effort in the result analysis to any of the swing. And then once we tackle those first two, we understand how we could look at the spread and volume analysis and how we look at the swing analysis. We're going to discuss a sequential bias analysis. A sequential bias analysis is basically your step-by-step approach as to how you need to dissect the trading range for the identification of the bias. Behind that, we're going to look at all of those concepts that we've learned in WTC1, combining them, very practical step-by-step approach. And in some instances, we're going to look at other types of bias analysis, which we've developed at Wyckoff Analytics with our students, flashcard bias analysis or quantifiable sequential bias analysis. So this is our attempt to quantify our analysis and make it way practical. So pretty cool stuff. And 2 homeworks, which are going to be mandatory homeworks for WTC2 students. Anatomy of the trade. This is where we look at our past trades and do the post-trade analysis, and bias game, which is the weekly bias game. I'll mention this later on. You could find it on our Twitter or on our website. And sometimes some people are really crazy. They've been taking this course for multiple times. Franz has taken this 13 times. Well, maybe because there is some value. Stop the recording, read his testimonial, and we're going to move forward. Today, what are we going to discuss today? Well, we're going through the introduction. I've already introduced the Q&A session throughout the whole class that we're going to do. Next on the agenda is just to talk about Jim Forte's Anatomy of a Trading Range article. This is the best article. I think that was written on the price structural analysis by anyone. Market update. This is a regular feature in each class. And then we'll dive into the material. We'll start with the discussion. Who was Richard Wyckoff? What is this heuristic of the composite operator? How does the Wyckoff method fit into the price cycle model? And after that, we'll start talking about behavioral market analysis. Who are market participants? What are the intentions behind their actions, behaviors in the market? And how could we see those on the chart? So once you understand who is present in the market and how their footsteps you could see on the chart, and you could see the result of their actions, then you can choose who are you gonna be with, the smart money or maybe the weak hands. So we'll talk about this. And then of course, session number 2 is gonna be a dive into way more complicated concepts. We'll start with the change of behavior, change of character. We'll talk about accumulation, distribution, reaccumulation, redistribution. It's going to take us actually multiple sessions, to cover this material. And homeworks. You will be labeling, guys. You will be looking through the structure, and that's what we want you guys to do in each class. So each class will have some kind of homework. Speaking of the homework, as I mentioned, your next week's homework is just to read one article. It feels like one article is not a big deal. It's a huge deal. Why is it a huge deal? Because I want you to read it in a specific way. I'm talking to students who already signed up right now, and I'm talking also to those of you who are going to sign up tonight or tomorrow. Read the article, but I want you to read the article with the pen or pencil. I want you to highlight any main ideas that you kind of see in this article. So I want you to be extremely thoughtful about what you're reading, because then you're going to come back and I'm going to give you the same material, but from my perspective. So it will be easier for you if you read the article to listen to my next session. And Anatomy of the Trade article will be posted. It's already posted on the class page. So, tonight we're going to add the video and the slides. So, but for you guys, for those already who are signed in, go check it out, print it out, start reading it after the class. You have 1 week, and we'll definitely discuss certain elements of that. Okay. Next, okay, another Q&A, exciting. Okay, does Wyckoff method work in the Forex market? Absolutely, it does work. I actually started my career with the trading Forex. I've traded Forex for 5 or 7 years, if I recall correctly. It was really, really at the beginning of my career, trading career. And you could use the concepts like the price cycle model. You could use the price structural analysis. I mean, a trading range is a trading range. An uptrend or a downtrend is just that. Those are trends. And trading ranges and trends are always going to have very, very similar characteristics. And then obviously the comparative analysis, especially in Forex, when you're comparing a pair like euro dollar to, let's say, pound dollar, those are going to be highly correlated at certain periods of time. So when that correlation is very high, you could compare them for strength and weakness, and you could choose what to trade to the upside, what to trade to the downside. And obviously there is a big question about the volume. Well, did you use the volume? Are you using the volume for your Forex market analysis? Yes, when I do have some volume, let's say like on TradingView, I'm gonna go for that and I'm gonna look at that volume. And even if it has some kind of discrepancy, it's totally fine because the major valleys and the peaks are gonna be depicted in that volume signature. So you could use that. But also, you know, for our advanced students, especially WTC2 students, we teach them how to read volume signature or strength of volume, the change in volume signature of the price. And that's a very, very important skill for an advanced trader. This is something that we could talk about more in tomorrow's class. Can I use Wyckoff method for intraday trading? Absolutely. I use it all the time for my intraday trading. And it's very successful because you could see, for instance, I love trading indices ES and Q, E-mini indices, you know, on the intraday basis. Sometimes I would trade stocks like Tesla, Nvidia, momentum type of stocks, right? So where you have a lot of move, a lot of liquidity. So those are also great tools to use Wyckoff method on the intraday basis. And yes, you could definitely do this. You could use price structural analysis. You could use volume and spread analysis. You could use swing analysis, comparative analysis. You could trade, and then my preference would be just to trade off the PNF because there you have everything that you need. You just combine it with the volume, and then you could do your tape reading, chart reading. You could do your horizontal PNF counts, and so on and so forth. So absolutely, Wyckoff methodology could be used and should be used for intraday trading. Soribel is asking, do you teach how to scan the market based on Wyckoff method? Indeed, we do. And a little bit further down, I'm going to show you our Wyckoff market report, and it's based on contextual Wyckoff scanning. So just stand by and we'll talk about this in a second. All right, let's talk about the market update. I haven't done this during the summer. We had a break for 2 weeks. Oh, I'm sorry, for 2 months. So this is usually how we would do this. We would have 8 major markets. Obviously, the top 4 is just the market itself, different indices, S&P, NASDAQ, Russell, the Dow, and then at the bottom you have the 10-year, crude oil, Bitcoin, and gold. So we usually would start with the markets themselves, right? So when we look at the S&P, what do we see? We have had a very big, enormous, huge structure. First of all, a downtrend. By the way, our call for the downtrend has happened on this bar right here. This is where we saw the preconditions for a change and then the reversal that broke the structure. And with this break of the structure, the suggestion was to the downside. And with the possible character and extension of that move, we've defined that this is our initial sign of weakness that's going to have the local stop in action, that's going to create some trading ranges. But right after this change of behavior, our definition of the market was to the downside. Then as we go down around this area in May, we started saying that we're going to start going into more bullish environment, but it's going to take, some finesse, some price structural buildup. This was identified as a local selling climax, and even though there is a discussion in the community, did we have enough of the capitulation? I'm on the side of no, we did not have enough of a global capitulation into the selling climax, but we most definitely had a very distinct and visible local capitulation, suggesting that from here we're going to go into some kind of trading range. A very big change of behavior rally that was suggestive of two things. The first one is that most likely we are done with the decline and we have some kind of bullish activity behind diminishing selling and some emergence of the demand. But the increase of the demand was not sufficient enough to produce, a more bullish rally by the character. You kind of see that we need not just demand off the bottom where we are buying on the way down, and by we, I mean the smart money, the institutional money, right? So they are buying as there is some value that is being created, where there is an oversold condition and where there is local liquidity event. It's usually at the selling climax, but there is no continuation of that buying, and that's suggested again coming back to the support of the selling climax, to the secondary tests and retest of this area right here. So here we are retesting, still pretty aggressive decline, pretty aggressive increase of the volume and supply. Again, suggestive two things, that the way how we stopped here with the spring event is suggestive that it's still bullish and we're going to come back into the trading range. But the aggressiveness of this decline and the amount of supply and the amount of selling was still suggestive that we're going to have a lot of testing being done after this decline. And indeed, we had quite a lot of tests. We're seeing how those reactions bring us to about, not necessarily the lower part of the trading range, but in the lower part, but with the banking crisis into one half of the trading range. And this is, very constructive. Plus, the volume comes in, it's a volume spike. With that, we are detecting what here behind inability to increase the downward result. Some presence of the opposing force, which is demand on the reaction. So banking crisis created that effort versus result situation, which is well described in the Wyckoff methodology. And just because of the volume signature, my labeling for this whole chart goes like this: preliminary support, selling climax, minor automatic rally, secondary test, phase A, upthrust action in phase B, secondary test as a minor sign of weakness, suggesting that selling is still done, as a local spring, because there is a spring right here below the support level. And then as we go up, minor sign of strength, last point of support, another minor sign of strength, last point of support. And because of this increase in the volume signature, I'm identifying that as a phase C. Phase C, how could it be that high? Well, because when we look at the formation that we are building here, we are actually in some kind of apex formation right here. And in apex formation, phase C is always going to be higher, always. So you have to identify it more on some other characteristics. So for instance, increase of volatility in phase C or into the low phase C, or increase in the volume signature itself without a prominent downward result. Then we see another minor sign of strength, and this reaction was so interesting as well for multiple reasons. First of all, structurally, this is a backup. In the apex formation, usually the backup comes to the downslope and resistance. And also look at the volume signature. You kind of could see how the supply is so dominant the volume spikes, the red volume bars, are more dominant than the demand. And yet, at the same time, as effort to the downside increases to push the price down, what happens with the result? Do you guys see that? Do you see that the downward result is actually not progressing? It's not increasing, it's not expanding. So with that, we know that the opposing force is hidden in this volume signature. Increase of the demand, suggestive of the local absorption, and local absorption is suggestive of the rally. But the position of where we are coming from this smaller mini structure is very peculiar because we are at the resistance level that we've been attacking for multiple times. We used it also before as the support. So this is the most important axis line, around like 4150 right here. And we're hanging around, as David Weiss would say, we're hugging the resistance. Usually after this type of pattern, absorption at the resistance level, not only will we have the continuation of the rally, that's number one. Secondly, we're going to have the increase of momentum. Why? Well, because absorption has happened. Supply is in strong hands, and the more supply is in strong hands, the easier it is for the price to actually go up. But not only that we've seen on the trend, in the uptrend, we're seeing also increase of the demand signature through the volume. And with that, what do we see? We see the breakout, and the breakout is very successful. First of all, we are breaking out of this highs right here, and then we're breaking off the breakout above the August high as well, and the extension is pretty nice. What happens next is, has drawn our attention around this area right here. So as we are looking at the triangle here with the decrease in supply signature, everything seems to be normal. The call here was just to continue to the upside. But then we're starting to lose the momentum. We're seeing the loss of momentum in the spread itself on the way up. And also we're seeing how all of the next attempts are kind of not going anywhere. And then suddenly supply comes in, produces a very interesting, what other people would call a reversal bar. And we're seeing the emergence of the supply that produces some downward result, but not necessarily a big downward result. So it's on the confirmation bar right here that we are stating that all of the preconditions for smaller reactions are there. Now we're breaking the local structure again on the increased supply signature, and therefore we're going to react. Where are we going to react? Our call was this gap and this high, and here we are. The fact that we didn't touch this line is very promising, but it doesn't really mean a lot right now. Even though we're seeing how supply has diminished into the second part of this reaction, so 1 and 2, we see that selling is not that aggressive, number one. Selling did not push the price to the support, number two. And then we had an opportunity to test this local stop in action. How do we test it? We rally, then we have this weird Thursday bar where we have Jackson Hole and all of the conversations as to how the Fed is going to proceed moving forward. I definitely have a lot of ideas as to what the Fed is going to do, how that's going to influence the market structure. We will be discussing it in our market updates on a weekly basis, and also I would suggest for you to guys check out the Wyckoff market discussion that I conduct on Wednesdays with my colleague Bruce Frazier. But for now, I would be thinking that immediately there is no danger to the established uptrend yet. What we've experienced is some kind of change of behavior that is suggestive that the environment might have changed to a trading range. So it's within the trading range that we need to define the bias. How do we do that? Well, we look at the supply, we look at the demand, and then we'll look at the result that those two produce. So what are we seeing as we coming into this trading range? Well, first of all, just the overall supply decrease tells us that, yeah, there is some profit taking, there is some rotation, but it doesn't necessarily mean that we are done with the uptrend. We might be in this type of trading range right here, and we just need to play the local structure. Seasonality suggested that after the change of behavior, we might be for several months in some kind of trading range, right? So we might be, doing something like this for some time. I think what's important for us to also understand is how other scenarios might potentially develop, right? What if in this structure right here, we have an attempt to rally and then we have a meaningful break? And if this break will be better than 1 or 2, where supply has increased dramatically, and then the price structure breaks the logical stop in action and the logical support level, then we will be saying that behind this break of a local structure, there is a more meaningful change of behavior. And the next rally will define to us what kind of bias potentially we could have here. Would it be just a local event of higher volatility like we have had during the banking crisis? Could we have the banking crisis number 2? Obviously a possibility, although I see how the Fed is trying to maneuver to soft landing, and they want to bring the liquidity where it's needed. So if it's banks, they're going to give that localized liquidity to the banks, and that's going to change the whole structure of banks and the market as well. So we'll have to see. But at this point, until it's broken, you have to go with the definition of the trend that is now. What is the current definition of the trend? Higher highs, higher lows. Therefore, an uptrend. Could the uptrend have a logical reaction to the logical support level? Yes. What is the character? Okay, well, we saw both increase of selling and then decrease of selling into the end of this reaction, and then a local stop in action. So right now we are going through the test, and we have to see how the test is going to unfold. Could you put a little bit more detail into Thursday and Friday bars with respect to their volume? Yeah, very interesting. Comes from Nile, okay, if I pronounce your name correctly. Familiar name. Have you been a student of ours? Okay, so here is our Thursday and here is Friday. And look at the volume signatures, right? So long-time student, yes, I definitely recognize the name. So on Wednesday, right here, what's our expectation? Our expectation is that we probably coming into the breakdown area right here. We're testing it. And my expectation for Thursday, going into Friday, Jerome Powell's talk, is that we're going to have some kind of attempt still to continue, which we did on the intraday level. We had an attempt to go higher than the previous day's high, and then quickly reversed, obviously, behind the Jackson Hole, narrative. And it's definitely an aggressive bar. It's the best downward bar that we have had since, let's say, this level right here, or maybe even since this time, so the banking crisis. So visually, it's very disturbing. But at the same time, you have to ask a question. Looking at the volume signature, how much of the volume signature relative to, let's say, initial decline that triggered this reaction we have? Okay, so we see in that vicinity, but somewhat slightly less. So slightly less selling brings us what result? What is the intention behind the Thursday's bar? It's to most definitely break something, right? So if there is a lot of aggression, if there is a lot of selling, then the intention behind the sellers is to break some kind of structure and push the price even lower. Did it happen? Except for committing below the last up bar, we did not have that break of the local structure. So when that tells me again that there is some force here behind this bar, which is the hidden demand, that comes in and there is some local absorption, Now we still have to see what kind of effect of that absorption we're gonna have. So we need to most definitely overcome this level. So far, this is the level for us to overcome, around 4,500. We need to overcome this high, and we need to overcome this breakdown. Also, if we extend to the left, we see that this level has, played out several times. And that's why I'm saying, we're in some kind of trading range formation, and the only way out of this to the downside, just to break, or trading, then trading more in the upper part, and then continuing to the upside. That will change the stride of the uptrend, and that will also be in line with the seasonality, which again is suggestive of the trading range going into October, November lows, seasonal lows, and then resumption of the uptrend. So that's how we kind of like look at this picture right here. So not broken yet, but we understand if it breaks, how it would break and how it would look. And that's one of the things, with Wyckoff methodology, is just creating different scenarios as to how the price could travel under different circumstances, and then just trading along those scenarios. The same for NASDAQ. Obviously, an outperformer, a lot of momentum to the upside. After this rally, what is the retracement? How much of this rally are we retracing? Maybe about 31.8%. How about that for those of you who are, Fibonacci lovers? And then we stopped. We have a higher low test. Thursday bar is intrusive, aggressive, and look at the volume signature. It's one of the highest volume signatures. So it's a valid sell-in right there. But again, did it break the structure? It did not break the structure. And now what is the follow-through to that sell-in on Thursday? On Friday, right away, we have an update. Today, we have an update. But those updates are not that impressive, right? Even though demand is coming in, what is the result? The result is the most important thing, guys. And we still don't see that localized emergence of the demand to transition into some kind of a progressing upward result. So we have to wait. We have to wait until we break, this line right here. And if we do, that would confirm that this reaction has been done. Okay, couple of questions. Wednesday was a bullish day. Okay, yes, Wednesday, we're talking about this day right here. But the trend was extremely bearish all day. The result was that the big red down day was the expanding volume and price from John P. Yeah, I love everything that Dick Arms has done in his life as a technician. Obviously, train as his indicator, and if I'm not mistaken. And it's useful to look at train as the definition of the cumulative effort of selling and buying. Okay, so there's no question there, just a comment. Okay. Is it better to do long-term analysis of the S&P from Lucas? Yeah, we regularly do that. I mean, the long-term analysis you don't have to do each day, right? So I usually kind of like zoom out at least to show you guys, 2009 lows, and then just to show that we're still in the uptrend. I bring a lot of the analogs. So for instance, like this, brings a lot of analogs in my mind as to how the price could unfold here, both bullish and bearish. So yeah, we do look at the long-term structure. Just wondering if behind Friday's smaller body but equal volume, you see accumulation hidden. As I said, Juan, we definitely could, could see the hidden demand. The main thing about the hidden demand, it's not that you could see the demand. I mean, like the next step for your development as a really good Wyckoff analyst is to understand what is the result behind that. So hopefully I've just repeated this multiple times for you to understand how important this is. Okay, do you think that August 25th was a significant bar? This one right here, right? August 25th, Friday. No, it was not. The spread is not expanding. and it doesn't break anything, doesn't break any local structure. Okay, let's look quickly at Russell. So Russell is stopping again at the place that we want. It's the support where we had the break before, where we had multiple attempts to overcome the trading range before, and more importantly, the capitulation bar. So again, we have to see what's going to happen here, right? So we are in some kind of smaller trading range. Will we have the ability, to observe, because demand is coming in, to observe the supply and to start, at least consolidating and then starting to break out. So it's just kind of like a wait period for us at this point. We need some kind of elements of the confirmations. How would confirmation come for the Dow Industrial? So overcoming a local resistance first, something that broke the structure. So those two levels, and obviously the level where we are is extremely important because of the multiple stopping actions. There are multiple attempts to break out and one breakout. So all of that is extremely important. Nelson is asking, can you explain what you call the capitulation bar? Yes, of course. This is a really great question for those of you who's going to sign up for the course. We're going to, discuss in details what the selling climax is, what the buying climax is, what are the variations, what are the local, global, intermediate stopping actions, what are the attributes to that. But basically, the stopping action is anything that stops the price from moving further down, and capitulation bar will be the bar that has the majority of selling, and usually that is a significant bar on extended spread and also on climactic volume signature. All right, so let me quickly go through some other assets. Gold. So after this reaction, we stated that this is a change of behavior with consistent selling. And I have developed a technical theory of why we have the selling here. Remember the banking crisis and when everyone went to gold and institutions created a hedge position in gold. Very logical. What would they do during the times of the high volatility? They would start buying insurance. How would they buy insurance? Well, in multiple ways. One of them is just buying gold. During the times of volatility, that could actually even extend and bring something more of like 2007, 2008 scenario with a very quick velocity to the downside of the price behind, those, bank crisis type of catalysts. So this is a hedge trade. Then we see the loss of the momentum. So what does it tell us? Well, they stop buying. There is no need to buy anymore once they have that hedge position. And then once the crisis is mitigated by the Fed, institutions are doing what? Institutions are actually starting to sell that hedge position. And maybe they're closing somewhere at the break even, maybe they're closing at slight profit or slight loss. They don't care. It's an insurance. That's how the insurance work. And with that, they leave this position. What happens afterwards? A period of inactivity, which leads to attempts to rally. The rallies are never overcoming the selling zone bar. We'll study those, so don't worry if this is something new. Multiple attempts to overcome those and failure, failure, failure. So we're still thinking that locally we are in a bearish pattern, and then globally we are in the bullish pattern. And that's the confusing part about a lot of charts. Like a lot of people, a lot of traders, students, there is a big confusion about how to use multi timeframes together. You could have different biases on different timeframes. And this is what I'm showing to you through the structure. I'm not really showing you different timeframes. I'm just showing you different structure. Yeah, global structure, local structure. So until we have something significant in terms of the potential change of behavior where we do something like this and then we hold around the resistance of where we stopped before, or maybe we overcome and then we hold, which will be even better. then we could say that we are resuming our long-term uptrend since the 2018, 19, and even earlier 16. So for now, we are in this local retest of the highs, and the inability to do that could potentially lead to lower prices somewhere around 1800, somewhere here. So it's all about this structure right now. Okay, let's look at Bitcoin. Lots of conversations with students and just on social about the Bitcoin. So we've, for the longest time, have been seeing this as a bullish structure, especially after the FTX catalyst that has the largest volume signature. But look at this, look at the extension of the breakdown of the structure. And we see in the shortening of the thrust on the breakdown of that structure, while volume increases quite exponentially, right? So that volume increase with an ability of the price to produce a much more meaningful decline is definitely bringing us to the conclusion that there is a hidden demand. And when demand occurred, so here is that kind of like idea. When demand occurs, what's going to happen next? Testing. And if this testing shows us very good characteristics of diminished selling and then localized higher lows, higher highs, then we are starting to see more bullish activity. So our call, once we started having this momentum and demand has come in, was just to the upside. That was pretty easy. And then as we go through the uptrend, we're just, kind of like proving what the market is doing. There is nothing else, right? When we look at the initial thrust to the upside and the character behind it, that's extremely bullish. The spread is increasing. There is local breakout and extension above the resistance. The demand increase is probably the best on the way up, and then it's on the way up. It's not on the way down, where they are buying value, let's say at the selling climax, or value at a shakeout. This is different. They are buying on the way up. This was the suggestion that we are done with going down, and now we will be in the uptrending mode. We have another extension here, but look at how shortening of the thrust is happening, and the last attempt for the demand to push the price up, and again shortening of the thrust. Again, all of these three things we've talked about that they need to happen into a very important downsloping resistance line. And then this area right here was very, very interesting. So I had quite a few correspondences of students. And there were both camps, continuation and then also just the breakdown. It was kind of evident from this shortening of the thrust that we probably going to retest this important bar right here and this important support. And then when we went into a smaller structure here with multiple attempts to go up and failure, go up and failure, go up and failure, and go up and failure on such decreased demand. That's it. This was the timing for the price to start going down. And not only that, our call was that we're going to increase the momentum to the downside. So I truly believe, and maybe, like if you want to attribute this to me, usually in Wyckoff methodology, the beginners are always going to be thinking about labeling. And more advanced students are going to be thinking about the bias. Advanced students will be thinking about all of that plus timing. And I would say, those who master the methodology would start thinking about how that movement, if they're correct on it, how is it going to unfold? What's going to be the velocity? What's going to be the speed? What's going to be the reaction? Where the price is going to stop, and so on and so forth. So, and that's, in my opinion, the Wyckoff way. And this is where I want the method to go. For us, Wyckoffians, to be that precise and to be, that in depth in terms of the discussing of how the price is going to go. All right. So what else? Dominic is asking, I'm new to the Wyckoff language to describe the market. when you use the word spread, as you're comparing the volume between the bars, yes. So this spread for me is just basically the low and the high of the bar. If you have the gap, you could have the true range, but this is something again that we'll talk in WTC1 in the second month. I'm gonna give you the definition of each possible bar and how to look at this. How do we define the spread? How do we define the range, and so on and so forth? So yeah, definitely we're gonna cover that. How can you use Wyckoff analysis to trade options from Saribal? Yeah, I love trading options. All of my swing positions, just options, directional option positions, and it just gives me that leverage that I love, the flexibility of going in, going out, and controlling the risk all the time, not like in the cash position or leverage position. So yeah, absolutely. But you just define where you would open the position so that your option premium would make sense. You define the strike, you define the expiration based on your understanding of the duration of the structure, which is also, a more advanced topic to discuss, not in this class. And that's how you trade it. So yeah, absolutely, we can trade it. Okay, last thing about Bitcoin. So decline, but we come to the support. Demand occurs. We see the hidden demand here. Again, occurrence of the demand or emergence of the demand means just that. It's there. It's temporarily absorbing the supply. What kind of effect it produces, that's a completely different thing. And with that, you always have to look at the result. What is the result of demand coming in? So far, I don't see a very encouraging result. I mean, look at all of these rallies. These are very mediocre rallies. But there is no follow through to the downside either. But for now, I'm thinking that locally, this is more of a bearish picture. And until it proves to me that it could rally into the high of this capitulation bar, breakdown bar that broke the local structure, it's non-impressive to me. So I'm waiting, and I have not been necessarily trading Bitcoin for a while just because there is no reason to. As a trader, you need to understand when to trade, and when not to trade. If there is no meaningful opportunity, I mean, this was a meaningful opportunity on the intraday and swing level, but not on the campaign level, probably. So you have to understand when to trade and when not to trade. So far, I'm just waiting for this to unfold and to show me whether it's going to be a continuation, a trading range, or some kind of collapse. How do you determine the duration of the structure? This is interesting. I can't wait to start. Saribal, okay. This is, again, one of those advanced topics, but right away I could give you a short answer. Look at the presence of the supply. If there is a lot of presence of the supply, how long is it gonna take time to absorb that supply through the structure, right? Okay, so I see that we have different type of traders here. Some traders are beginners, some traders are more advanced, which is great, which is the usual mix. And we'll be talking about different subjects at different levels, so no worries. Okay, oil, probably one of my favorite charts to analyze. Right here on this bar, we said that we're going into a bullish environment. It's been pretty tough to stay with that call, but it's been pretty easy once the price shows some of the bullish activities. For instance, which ones? Well, first of all, just an ability to stay in the value zone for a while. We didn't have this in the downtrend. I mean, like, look how quickly we go down from each trading range. Why? Again, that idea about the duration of the trading range. Why is trading range increases the duration here? Well, because the hidden demand suggests that there was buying, and with that absorption of selling, so there is less selling than before. Then we go into a terminal spring, where the recovery almost immediate. Also, a bullish sign looks scary, looks bearish, looks bullish. That's the term that I coined, when we talk about the analysis. Looks bearish, but X bullish, right? So again, hidden demand. Really good rally, but supply comes in behind the OPEC over the weekend announcement. That was smartly done. This is the footprint of the CO, of the actual CO. And because of this increase of the supply, that is suggestive that we're going to have the reaction where two initial aggressiveness and emergence of the supply is suggestive that we're going to retest and we're going to do the double bottom. Ironically, I mean, like our analysis was pretty spot on, but we were thinking that we're going to have this type of structure. So extending a little bit more, but this supply was too much to carry. Okay, so what happens next? We said that this was the most important bar. Anything below it is going to be to the downside. Anything above it is going to be to the upside in terms of the buys. But we said that we're going to go through the testing. Not only that, remember what I said about being a Wyckoff. You cannot stop at thinking about just the bias or the timing. You have to think about the character as well. So we said that the testing is going to be complex, and that the testing is going to be probably bullish, bearish, bullish type of environment, meaning that you have your typical higher, low, lower volatility type of test first, then volatility is going to increase, and then volatility is going to start decreasing, and locally we're going to start seeing higher highs, higher lows. Happened exactly this way, right? So this is the first part of the test, then volatility suddenly increases, and then we see the decrease of volatility here. And for the first time, we see a slightly higher low, and then we see a higher high. So this was a very predictable rally, and the character of the rally itself is suggestive of bullish behavior. Why? There's a lot of buying here that we see in the volume signature. There is really great extension of the rally. Look at all of the reactions, very controllable by the buyers, rally without very deep reactions. And the duration increases. Again, duration of the rally is extremely important. Now, Sorobel, from other perspective, right? So I'll challenge your thinking here, and let me know if you could figure out why duration for the rally matters compared, let's say, like to this rally right here. This is a really good advanced question. So what else bullish we see here? Ability of the price to overcome 200 moving average, which it didn't do before. Extension above that, extension above the downslope and resistance. And then look at the reaction, the change of behavior. That is suggestive that, okay, maybe we stop here around this support from both moving average and the downsloping resistance that becomes the support. And look at the supply. What does it do relative to, let's say, this area, this area, this area, this area? It's really, declining relative to those areas. So with that, we are most definitely seeing less selling, and we're seeing less of the reaction. We are retracing only about 23.8%. How about that, right? So with that, our suggestion here is that for now, we still have some room to consolidate here. We could go lower, go higher, and do something like this. But if we break this level right here, this is our level to break, then I would say, like we did here, we said everything here is any commitment down is going to be to the downside. If we commit below this level, then we are most definitely still in a much larger structure, and we would be retesting the low. Okay, all right. Randall is asking, speaking of duration, will you be going over the Wyckoff waves? Yes, but more in WTC2 because it's more advanced material. Speaking of major events, gapping up, down structures, when you come to the stocks, can you please discuss how to read those earnings bars? Yes, we'll do that as well, Neely. Okay, all right. And I think we're gonna stop here with the market analysis. It's 4:07, we're a little bit behind. We'll talk about the 10-year in the next session, and we'll talk about why it's important, in the relationship to the markets. Okay, great. All right, so for those of you who are interested in this type of the analysis where you just compare your notes, or where maybe you are our Wyckoff student, you went through the program and you still want to remain the part of the community, you want to receive the weekly analysis, you want to always be in that Wyckoff thinking, come to Wyckoff Market Discussion each Wednesday at 3 p.m. Pacific, together with Bruce, who has enormous experience trading, teaching Wyckoff methodology. And each session with him is like a storytelling. He tells stories. So I would absolutely recommend that. $79 per month, and I'm sorry, $99 per month, and on promotion is going to be $79. So you could just become a member and then just wait for the promotion to match the price. And we discussed the market, we discussed the stock selection, top-down approach. We use different filtering, scanning techniques, and then we look at some of your charts if someone sends us anything. And usually discussions are very in-depth into the market. Speaking of Wyckoff contextual scanning, Wyckoff Market Report, which is published by one of our team members, Johnny Scan, is for you to have, and check out what John does there. First of all, he does all of the scans based on Wyckoff contextual events: spring, last point of supports, up thrusts, backups, breakdowns, and so on and so forth. Then you also have the definition for the market: what is performing well, what is not performing well. And then he takes those scans, and those numbers are actually number of stocks in that particular category. So he shows you all of those stocks. You could go over the weekend through that stock report and define which stocks are of most interest to you. So it's a very, very interesting and easy way for your over the weekend selection to go through the scans that John has created and just to identify what's of interest. Okay, let's go to the next Q&A session. Abdul Haq is saying Wyckoff method is one of my best and logical methods to analyze the market. I agree. John P is saying WMD is amazing. Thank you. Let's look at the questions. What expectations should I have when taking the WTC1 course? First expectation, drinking from the fire hose amount of information, not house. Yeah, students have been jokingly complaining that I give too much material in this course, and that there is so much information they have to re-listen multiple times. Unfortunately, that's the case. I want to give you as much as possible in the shortest period of time, and then you're going to have the access to this material for a year after the course, with the option to renew the access, and therefore come back, rewatch, re-listen. Some people come back to the live course as an alumni of WTC1 because they want to understand all of this information. It needs to be absorbed by your minds. It needs to be adopted. So there is so much that I give you throughout this whole 15 weeks. Then back to school with homeworks. This is just a reminder that this could be the course where you just watch the videos, for sure. Yes, of course. And I would encourage you to do that over doing nothing. But I also would encourage you, as long as you're already here, as long as you already signed up for the course, as long as you're already committed to this, then, just do the homeworks. It will progress your knowledge and skill way more than just observing, than just listening in. Number 3, you will drastically change the way you analyze and see the charts. Students regularly, starting from the second and going into the third months of the course, report to us that I see market different. It's almost like sixth sense. I see structures everywhere in the market. I see trading ranges, I see uptrends, I see changes of behavior, I see supply, I see demand, I see that relationship, I see how it starts to influence the price structure. So it's almost like this popcorn aha effect that happens to people once they went through the price structural segment and supply and demand segment. And there is a lot of that popcorn effect in the classroom. Number 4, students report to us, this is by far the best investment into my trading education. So I would not comment a lot here. I'm just relaying to what students are actually telling and reporting to us. If that's the case, we've heard a lot of like, this is the best course, this is the best investment, this is the best teaching, this is the best material, this is the best Wyckoff course, this is the best technical analysis course, this is a foundational course. We love all of those comments, so keep them coming. And I just wanted to want to relate this to you. Okay, next question. Can I expect an immediate improvement in my trading after completing the WTC1 course? So I'm always honest with myself. First of all, I think that the best traders are at the highest self-honesty level. You have to know yourself so well in order for you to operate optimally and profitably in the market. So therefore, I'm going to tell you exactly what I think about this question. If you are an intermediate advanced trader, then the immediate impact on your trading will be visible. Then yes. If you're new to trading in general or to Wyckoff method, it might take some time. It's not going to happen to you right away. So I don't want to build your expectation that, let's say you're a complete beginner, you take our course in 3 to 4 months, you will definitely know how to read the chart, you will know how to analyze the forces behind institutional buying and selling, you will understand what are the most optimal best spots to open the position, close the position, add, trim the position. But it's not necessarily means automatically that you will be making money. There is way, way more into being profitable than just being a good analyst. You have to develop the skills of visual recognition of all of the Wyckoff concepts that we're discussing in these classes on the chart itself. And also, how do you execute this? So you need to build quite a lot of things before you become profitable. So what are those things? So again, students report to us that it takes them about a year and a half to complete the following process. First, to acquire the knowledge, whether through WTC1 or other courses. We have quite a lot of courses on the knowledge. Then develop the skill. And this is where I love to reside a lot. I love this level of developing the skills. Each day I have some kind of simulation. Literally, I just go, put up the chart in front of me and go bar by bar. That's my routine every day, except for the weekend. Why do I do this? Why do I simulate so much? Because I do believe strongly in deliberate practice and the results of the deliberate practice. And when people just come and they acquire the knowledge and then they come back to me and they say like, I can't really do anything in the market, even though I know what's going on. Why is that? The answer is very simple. The skills of recognition and execution were not developed or were not developed properly. So WTC2 is the next step, is that next very, very important transition into the mastery. So there is a lot of homeworks, there is a lot of simulation, training, and if anything, from educational company, we are becoming more and more training company. We're training people to become traders and not just somebody who just watches the market on the screen. Then step number 3, establish the trading process. So we have the Trust the Process Special, which is a total proprietary thing that we've developed for our students and ourselves, and the process group. So I want to say a couple of words. Our community is amazing. We've just had the Best of Wyckoff unconference in San Francisco in July, where our students and the whole team came, and we've been together for 3 days, interacting, learning from each other, studying, doing the workshops. Check out the workshops, by the way, the intraday and the swing workshop on our website. It's just such an amazing group of people that are really down to earth, that love to work, that love figuring things out, or everything market related, that support each other, and that are just like a happy members of our community. So a process group is just one of our mini groups that we have, for our community. And then the last thing, it's more for advanced traders. It's not for the beginners. It's not for intermediate traders. It's all about the mindset, and we do those in private sessions. We have a couple of specials that you could watch as well, but mostly it's working at that higher level of why do we behave in the market in a specific way, usually that goes into your life, into your childhood, and so on and so forth. So we look into that as much as we can. All right, let's talk about Richard D. Wyckoff himself. But before that, let's answer some of the questions. Nile, I'm not sure about the comments, so maybe you could expand on this. From Hayward. Oh, hey, Hayward. Okay. Does the alumni rate apply only to the next immediate course? So anytime we want to rejoin, anytime you want to rejoin, Hayward. So of course, you're an alumni. So just come back, email Nancy, and just say like, I want to rejoin, or just go to the website and just do that. Would be happy to have you back. Do you give a trading plan during the course? Do you share trading samples from Wyckoff Analysis? So there are so many trades that we post on the social media, so just go there just to look at the trades. I also show some of the trades in WTC2 for the anatomy of the trade. We have the whole series on the anatomy of the trade with our students showing what they are doing, during the classes, right? So the class is on, and then they are showing what kind of trades they're doing, and we analyze it together. So there is so much material on that. Do you give a trading plan during the course? At the end of this semester in WTC1, I'm going to give you a pro forma, which you will have to individualize for your own trading, because somebody might be an intraday trader, someone might be a campaign trader, somebody's trading cryptos, someone's trading futures or options. Those things, they need to be individualized in the trading plan. But I'm giving you the pro forma that you could use for all of those reasons. Okay, Alfredo is saying, I'm so happy to be back, Roman. Yeah, I see a lot of familiar faces, not faces, names. So guys, yeah, absolutely. If you feel like you're an alumni, you want to refresh, you want to dive in again, just do, WTC1 or go for WTC2. I mean, the way how we've developed WTC2, wow, it's so exciting. I mean, just the whole idea about the sequential bias analysis, very well defined, significant bar analysis and swing analysis, it all came together. So if you want to refresh first and then continue with WTC2, I would say like that's the path to go. All right, let's talk about Richard D. Wyckoff, and I want to highlight Stella Asoba here. Stella came to our community because we found her article that she published in Stocks and Commodities way long ago. It was 5 parts on Richard D. Wyckoff, his biography, and I thought that was so brilliant. So we invited Stella to one of our Best of Wyckoff conferences, which was online at that time, and she just delivered such an amazing 2019 Best of Wyckoff. Just amazing presentation that you could watch for free on our website. Just find the Best of Wyckoff 2019 and go watch all of the presentations from that year. And then also, I would absolutely recommend finding this article and reading about Richard D. Wyckoff. So who was he? I'd say like he had obviously a lot of hats wearing, during his life. He started as a boy being, a runner for the bucket shop. And then later on, he had become such an authority on the stock market analysis that he founded and became an editor of the magazine of Wall Street, which was founded in 1907, and I believe, if I'm correct, was sold or closed out in 1974 by the Here's of his second wife who he divorced, and that was the worst trade possible that he has made. His second marriage, his wife just cleaned him out. But at least that forced him to produce probably the most meaningful work that is important to us, and that is the original course by Wyckoff Associates. Right, so it came out in the early 1930s, and then that has become kind of like the main course. When students ask me, okay, should I read the course? Yes, but I want you to read it at a specific time. Do not read it when you're doing WTC1. Okay, read it when you're going to be a more advanced Wyckoffian. Read it in between WTC1 and WTC2. Read it during WTC2. Read it after WTC2. It's really outdated, and it's not necessarily an easy read so far, but it's a kind of like a must read if you are going to be advancing in your studies. Also, Richard D. Wyckoff has published many books, and again, like I'm teaching Wyckoff, I'm trading Wyckoff. People always ask me questions about Wyckoff. Should I read the books by Wyckoff? Yes, you should, but again, read them only when you are done with the fundamentals. And unfortunately, the best fundamentals are more modern version of the method rather than an outdated 100-year-old almost like version of the methodology. So start somewhere with modern take on a modern adaptation on the method, and then switch back to Richard D. Wyckoff himself. It would make more sense to you. He was a publisher of the ticker. Look at the at the people that he interviewed or he wrote about, William D. and so they were definitely familiar. Wyckoff knew Jesse Livermore, obviously. He knew J.P. Morgan, James Keen, all of the main big operators, stock operators, the futures operators at that time. And then obviously the Magazine of Wall Street, so many great articles that were published there. You could find a lot of all of this in the public domain, so just go Google it, and some of that will be completely free. Okay, great. Let me see some comments. Which conference has the presentation by Hank Pruden? 2017 was his last presentation by Hank, and then a week after he passed away. That was his last presentation at our Best of Wyckoff in August of 2017. I read the history of Jesse Livermore, and I see that Wyckoff took some techniques from Livermore. Is this correct? Absolutely, yes. He actually codified a lot of principles of different market operators of his time. And Jesse Livermore obviously was one of the operators at that time, and he has codified a lot of the stuff that Jesse has been doing trading. So absolutely, Jesse is a Wyckoffian, or rather, should I say that Wyckoff, is more like a Jesse Livermore type of trader. Okay, couple of other questions. All right, do you use a Wyckoff method in your trading? Yes, I only use Wyckoff method in my trading. I mean, I've studied for CMT, which is the Chartered Market Technician Association, for their exams, passed the first two and then kind of stopped there. So I've studied all of the technical analysis methodologies, and it just, my heart went to Wyckoff method because it made most logical sense to me. It was in line with my intellectual pursuits, in line with the way how I wanted to have a set of beliefs about the market itself. It allowed me, to think about what is the dominant force, and also allowed me to be precise in terms of the timing and precise in terms of the selection of the future character of the possible move. So there were so many pluses for me use the method that not only I've been using it in my trading, I started teaching it. And obviously when you teach, you go even more in depth, and it's just been such a great journey, you know, for me personally and for people around me. It's just like there is a lot of passion about the method itself. And it's kind of a hidden gem a little bit. Not a lot of people know about it. What are your results? So first of all, I'm trading on different levels, right? So I've just finished a 3-year hedge fund trading investing. I was a core manager of the hedge fund. The last year I would have to double check on that with our administrator, but all 3 years were profitable, and that's on the hedge fund level. So those are just millions of dollars that you have to invest. I mean, like at times we would have something between 20 to like 50 positions, so you can imagine how difficult it is. Just go on the daily basis through all of the positions and look at your watch list and so on and so forth. I do have the private IRA investing account, which I basically don't look on the daily basis at all. I mean, like the things that I bought for that account is obviously way, way profitable because the positions were opened, 3, 4, 5 years ago. For instance, I'm still holding GLD ETF, the gold ETF that I bought back in 2019. So for 4 years, I've been in that position and I'm not going anywhere, at least for now. And then private speculative short-term trading, which is a lot of fun. So I allow myself to have fun trading something that of interest to me. So for instance, I could be trading Bitcoin, which moves so fast. I could be trading option positions on stocks like Nvidia, Tesla. Those are most exciting trades that I usually have for myself. So that account is much smaller because it's more speculative, it's more protective. And then once I make some, considerable chunk of money, I just move it either into IRA or some other account. So sometimes also just for transparency purposes, I want to say that there are some periods of time when I'm trading more aggressively and I'm trading less aggressively. So for instance, as like an example with Bitcoin, I decided to not trade Bitcoin for a while just because I didn't see that increase of volatility, just localized increase of volatility. So I didn't see opportunities there. I'm at the level of trading where I don't care about the time frame, I don't care about the asset because I've traded all of them. I care more about the opportunity that is in front of us. Do I recognize it and can I trade it and can I leverage it to the point where I'm going to make a meaningful return? So if I'm right, I want to be like George Soros. I want to be a pig when I'm right, and to load up and to add according to the logic of risk control, and at the same time elevating the efficiency of my trade when I'm right. And again, those are really advanced concepts. Those are usually being discussed in WTC2 class with more advanced students. So yeah. Can you show your latest trade? Yes. Look at the following trade. This is literally kind of like one of the latest trades that I've had. This trade was, the intention behind this trade was a swing or campaign trade. So I opened the position right here. Why am I doing this? Well, we have a downtrend, stop in action, right? Trading range, we're seeing how supply has diminished. We see that momentum is decreasing on the way down. Momentum is trying to increase, but no follow through, multiple tests afterwards, and then a very dynamic change of behavior, which is being followed by a horizontal test in action, localized spring, really good response from the spring, really good response through the breakout area. So a lot of this is just fits into the methodology concepts of dominance, let's say in this case of the demand, that builds the structure of an uptrend. So you want to come in the area where the uptrend starts to emerge. So and this was the first spot where I thought that I could easily, with high probability, enter the position. Again, intention was to wait for a long time for the price to advance significantly, and it kind of spooked me a little bit here. So I made a major trim. I was taking some rotation behind, the mega 8 big caps out. So my idea was that we're going to go into some kind of trading range, and again, the duration of it should have increased. So I was thinking that it would be better to trim more and then to start building this position again. So I'm still holding a small percent of this campaign, and now it is a campaign. Now it's not necessarily a swing. I might add, some options to the swing position here. It's possible if under certain circumstances we start improving here. I would have to see this, but this is like a very typical and atypical also campaign for me. Typical in the sense that yes, it is a swing campaign trade. It's a typical place where I would be thinking of entering the position. It's a typical place where I would be trimming the position, but it's a typical because I've been doing a lot of the intraday trading lately, and less so swing trading. And both actually were going okay, but this is the trade that I decided to show you. All right, another question here: why more people are not using Wyckoff method? It's just too hard to master. It is taking a lot of time, and to acquire the knowledge first. There is a lot of knowledge. I mean, the market could be very simple. I mean, it could be buy and sell buttons on your cell phone, but behind those pushes of the button, there is an analysis, and there is certain steps. And to get to that final push the buy button or push the sell button is a lot of thought processing that we need to do. We need to create the beliefs of how we think about the market. Based on that, we need to understand the opportunities that the market presents at a specific time. That we need to develop the skills of execution and strong mindset, to execute in such way that a loss would be considered mentally as a step forward rather than a step back. So there is so much to trading than just the method itself. And that's why it's really hard. It's really hard to become profitable, to become consistently profitable, and then to come to the level where you're actually making money for a living, and at your level you understand what opportunity means, rather than what specific market you trade. All right, let's go. Do you trade the ranges? Sometimes, but to me, those are not necessarily like, those are higher probability trades, but those are not extending beyond the targets that I usually would love to have. So sometimes, yeah, for sure, but mostly, usually on the intraday level, I have a lot of counter trending trades relative to the trend, which could be a part of the trading range structure. So with that, yes, there I definitely do a lot of ranging type of trades. Let's talk about the composite operator. The composite operator is a heuristic that we use. So we always talk about smart money, strong hands, institutional hands. This is how Wyckoff described what a composite man is in the magazine of Wall Street. This is his own article. Please read it. It's just one page, but I'm going to concentrate only on this piece. Who is the composite man, and where can he be found? He consists of some 2 million personalities scattered over the face of Earth. So I would be assuming that he talks about all of the traders at that time. So it's a lot of traders. Some of his component parts are richer, more powerful than others. So we are talking about, maybe like institutional traders, something like JP Morgan at that time. Some are noted for their foresight, intuition, shrewdness, conservatism. Okay, so maybe analysts at that time. some for the dashing, daring, reckless quality of their move, speculators. These millions of personalities form one, omniscient, who sways the market, crushing those who don't know and will not learn how to benefit by him, and crowning with profits and income those who do. So as you could see, our definition of the composite operator, or the composite man from before, at least where I was taught, was completely incorrect. Because when we talked about the composite man, right away there was this reference to the institutions. I've managed money as a hedge fund manager. Let me tell you this, just knowing that kind of like background and landscape and people behind it and so on and so forth. There are so many smart men managing the money. Men, I mean in plural, men and women. And there are also money managers who just don't know what they're doing, unfortunately. And with that, they are not strong hands. With that, they are not the composite men. In fact, the investors, institutions that we would usually perceive as composite men, for instance, somebody like Warren Buffett, makes mistakes. And therefore, it's on the individual trade basis that we define whether they are a composite man, a strong hand in that particular trade or not, relative to the business cycle timeline. So I started teaching my students that institutions are not automatically the composite man. Institutions are not the composite operator. Institutions that are on the correct side of the trade, those are your composite operators. But also, I was pleasantly surprised when I read this original Wyckoff definition of the composite man that it doesn't only include institutions themselves who trade, but analysts, speculators. It could be even, some, like in the current settings, some TV personalities that give some kind of assessment of the market, some kind of advice, and then they influence other people to buy or to sell. And those people who are going to be on the correct side of it are could be considered the composite operators. So it's all encompassing. It's not just institutions that are the composite men. Way like incorrect. So what does the composite man or a composite operator do? In theory, sits behind the scenes, manipulates stocks to his or her advantage. If you do not understand the game, then you're not going to profit. You're going to be always on the other side. You're always going to be a weak hand. So our goal is to understand what the composite men like JP Morgan at that time, James Keen, Jesse Livermore were doing. Where do they commit the money? To which positions? What do they select? In which market? How do they position themselves? What is the size? Where is their stop losses? How do they operate during the uptrend, during the downtrend? And if we do that, if we see that man's careful planning and execution and the whole campaign, we could kind of like, drive alongside this composite man, right? So as we see what they do and we understand that the price structure is going to develop behind the humongous big orders of millions and billions of dollars going into the specific asset, we will be there. We will understand why this happens and what is the high probability result of that. And that's the whole idea behind the composite man and why we would want to follow that. Speaking of accumulation in the distribution and the campaigns, you know that one of our best free products that we have that the whole company produces on the weekly basis is the bias game. The bias game is a puzzle. The puzzle that I want you to solve on the weekly basis. So even if you are not going to become our student, become a member of our community at Wyckoff Analysis. This is our Twitter handle. Go there, and then on Wednesday we release the assignment slide with the question: do you think that this is an accumulation or a distribution? You can do your analysis, print it out, do your analysis, and then on Friday wait for the solution slide. If you want to work much faster, go to our website, wyckoffanalytics.com, find the bias game there, and start playing from bias game number 1. We are on bias game number 206 right now. So this has been going on, as you could see, for quite some time, for 4 years. So this is one of the best teaching tools and self-teaching tools that you could have. As you do your analysis, then you have the ability to compare it to our analysis and to the Wyckoff story that I personally wrote. And you will compare your understanding of what has happened to my understanding what has happened. So again, skill building is essential, and this is not just a knowledge learning tool, that's also your training, a part of your training, and a huge part of WTC too, where we take each bias game and we discuss it in so details, and people show the work that they do. So as you could see, we definitely, I stress a lot of emphasis on practice, on knowledge acquisition, on being honest with yourself, on being in a reframing from negative to positive mindset around any of the temporary failures that we have. How many failures do you guys have had in your trading career? I've had plenty. I mean, like, I could write a whole book just, describing all of my failures and successes, right? So we all connect to each other in that way. It's an immensely difficult task to make profits from the market, but at the same time, it is absolutely possible to do that. Okay, what are the major goals while using the Wyckoff method? Okay, make the correct observations about market participants' behaviors, what they do there, right? So we're going to look at the volume, we're going to look at the price, we're going to look at the structure, we're going to look at the sentiment, we're going to extract the sentiment from the price structure and from the volume signature. And as we look at the chart, we're going to start creating what we call the Wyckoff story. The Wyckoff story goes from left to right, and it depicts the story of the dominance of the force. What force is dominating in this period of the chart? And then as we go to the right, we shift, and maybe there is a change of behavior that is suggested that the other force is overtaking, and that's going to create the new environment, the new price structure. And then in this price structure, we're going to start observing the behaviors of sellers and buyers. We're going to have specific levels for us to overcome or not to overcome and fail. And that's how the whole Wyckoff story is being created. It's a fascinating read. You need to learn how to read the chart. And if the observations is the first step on how to read the chart, I also find that behind the poor observational skills that we all have, and a quick example of that, okay, well, look around you, right? You're probably in some room, maybe like sitting on your cell phone or your computer, listening to this lecture. How many books do you have around you? What are the colors of those books? What are the names of the authors and the names of the title names? What are the sizes? How many pages? How old are those books? Where exactly are they on your shelf? Do you get the point? There are a lot of data points that we need to extract from the chart, and then we need to make the correct deductions. And unfortunately, I see a lot of kind of like very subjective biases that are influencing people's observations even, let alone deductions from that. And so those are major goals for us to understand how to observe the chart correctly and how to make the correct deductions. And then once we do that, just to trade alongside the smart money. Okay, where do we start our Wyckoff analysis? Or rather, what are we gonna, do? What is our initial orientation? Price cycle model, behavioral market analysis, change of behavior versus change of character, Wyckoff accumulation, distributional price structures, trend analysis, volume spread analysis with swing analysis, sequential bias analysis, and comparative and relative analysis. This is where we're going to reside for for 2 semesters. And we're going to increase the level of complexity with each layer. So we're going to start with the basics. We need to build the foundation, and then we're going to go into intermediate and advanced concepts. So let's start with the foundational concept, the concept of the price cycle. This is a very simple representation of the price cycle. We have an area of the accumulation that is going to be associated here with the exchange of shares between the strong hands that are buying and weak hands that are selling. And it requires some time for the sentiment to change, for the selling to diminish, and for the buying to be able to absorb all of the selling, all of the supply. That's why the trading ranges exist, just because of that process. It takes some time. Then once absorption is complete, we go into the emergence of the uptrend. During this emergence of the uptrend, other institutions, rather than, let's say, value institutions, contrarian institutions, Warren Buffett type of institutions that acquired their shares on the way down at the point of value and at the, let's say, some kind of extreme liquidity event, like a selling climax, where they could establish the meaningful position. They don't care about the time. Their time horizon is over, a business cycle. So they are willing to wait, and to wait for the better price, to wait for that liquidity to get more shares. And once that is done, the next set of institutions come in, and they start seeing that absorption by the value investors, and they start buying as well. That starts pushing the price out of the accumulation range. And this is the area that I call the emergence of the new uptrend. Once the uptrend is established, we have different parts to the uptrend. Let's say 1, 2, 3. One could be a momentum behind initial buying. 2 could be a vertical absorption behind some partial profit taking and some rotation. And third a part could belong to the speculators, where supply is in strong hands and the majority of traders now on the correct side of the trade. This part right here is the only part in the uptrend where majority of the traders are on the same side. And this is why a lot of the weak hands, especially public hands, are being so drawn into the market. The market gives them an opportunity to experience profit at some point, and then they can't go away. And they have to reproduce this. The first time that they try to reproduce this is during the distributional area. So as the value contrarian investors are actually selling, they are selling over value. The weak hands, encouraged by the previous results, are actually aggressive buyers at the support level. So you could see how exchange of shares happens throughout the trading range, and then there is a break. Once there is no support, the price just falls down and we go into the markdown or a downtrend. Of course, this is a simplified way of looking at the price cycle. This is a little bit more complex. So as we look at the trading range environment, we see that the trading range first starts with the attempts to stop the price action at the preliminary support. Those are already first buying opportunities by institutions, or at the selling climax, where we have that increased liquidity, we have that capitulation behind the gaps down, behind the increased spread, behind the extreme volume, which we call the climactic volume signature. And from there, as the point of value is being created for the contrarian investor, as the liquidity event is unfolding, they are becoming heavy buyers. As their models are saying that valuation for that company is somewhere there, somewhere up high. So why wouldn't they be buying here? This buying, increase in buying, produces some kind of change of behavior. The best rally in the downtrend, or the best rally in the last decline. And what happens here with the sellers? First of all, as they were selling on the way down, that supply is being absorbed, and more prolific sellers that are in profitable positions are now closing their short positions. And as they close, their short positions are being converted into the market orders to buy. And with that, again, demand is increasing and the upward result is increasing and the change of behavior happens. And the change of behavior is suggestive that we're going to go into a trading range. And after that, once we understand that we are going into a trading range environment, there are only three questions that we need to address. What is the bias of the trading range? What is the timing for us to open the position? And what will be the character of the next possible uptrend or uptrending move, right? So we go through phases, phase A, phase B, phase C, phase D, and then phase E is our uptrend. So each phase has some kind of character. So for instance, if phase A is all about stopping action, what do we stop? We stop the downtrend. Then phase B is our preparation phase, where we go through ups and downs, where there is a lot of volatility and then sudden decrease of volatility. Because of that up and down, that creates a lot of buying and selling, and absorption process is taking place through phase B. And this is the area of supply and demand war. This is the area of uncertainty becoming more manageable and clear, and you could start seeing more of the directional bias for this trading range. Phase C is our last test of the supply at the lower level, and then emergence of the uptrend in phase D with the sign of strength rally, which has a different character than the previous rallies, and then also with the reaction to the backup action, to the backup low, which is also different than any of the reactions that we have seen in the trading range. So a new change of behavior, a new change of character in the price structure with the suggestion of the continuation of the uptrend. And then we complicate it even more. So now look at this price cycle. What do we see here? We see the same schematics where we take one trading range, we go through all of the phases. Phases have their own events, local events, right? So I'm just want to show you the complexity of it all. And this is just one trading range in the price cycle. So you have to understand, the strategic definition of the price cycle model as a big tree that has a lot of branches. So let's say like either an upswing or a trading range, upswing trading range, downswing trading range. And then during those trading ranges, so during those upswings, downswings, you have a lot of different events. You have, let's say, maybe like overbought conditions, oversold conditions. You have in the trading range so many Wyckoff events and phases, and we have to study all of that. But that's how the market unfolds, and that's how the price structure unfolds. Here is an example of the very long price structure. This is Apple, probably one of my favorite stocks, all time, where we just find numerous examples of different price structures. It's just such a great case study. And we're seeing how a very long-term, very complex price structure takes place between 1987, when Steve Jobs, goes away, into 1996 when he comes back, into 2003 after the 2001 decline from the tech bust. And after that, we're seeing just up, and we're still going up. And if we look at the big cycle, we see that big trading range, a big secular causality that transforms into the secular effect. And then within each structure, we see mini price cycles. We see, for instance, a trading range right here that leads to the uptrend, that leads to a distributional range, that leads to a downtrend, that leads to a trading range, that leads to an uptrend, that leads to a distributional range, that leads to the downtrend, and so on and so forth. So it's fractal and it repeats itself. But the key here is the variation, because the variations on the trading ranges, or the way how the price actually goes up and down, could be different. And that's what we need to study. And that's what we're studying in our classes. You know, how to see this and then how to actually take advantage of that. Okay, more freebies from us. Weekly newsletter, sign up for that. We also publish this on Twitter as well. We just started publishing it on Twitter, so do go there if you want to find the newsletter. Our YouTube channel has close to 900 videos. So you could imagine that you could just educate yourself just based on that alone. Of course, we are not covering everything there. And in a lot of cases, there are a lot of repetitions there. There are a lot of market update videos as well. But if you concentrate on the main legacy videos, you could definitely study a lot of the Wyckoff method. And then our Twitter handle is at Wyckoff Analysis. So go check us out. You know, scroll down, look at how we did in the last, let's say, like, you know, when did we start? In 2019. So 4 years, in the last 4 years. Okay, why? This is just the letter for the person. It says your YouTube is #1 of the best free resources to study. Thanks. Absolutely. Can you analyze one of the AI stocks from Sorryball? Okay, if we have time, we'll do that. Yeah, we still have quite a lot to go through. Okay, Wyckoff schematics, the next Q&A session. Wyckoff schematics. Oh, I'm sorry, this is misspelling. Do Wyckoff schematics predict the future path of the price? No, they don't. I know in 2021, there was such a huge splash from the crypto traders when they saw a distributional schematic and the price matched almost completely the schematics, the Wyckoff schematics. And there was like such a big deal about this in the crypto community. And that obviously was the bubble that needed to be busted because people just didn't truly understand what schematic is. We use schematics as a guideline as to how the price might potentially develop under similar market conditions, but not necessarily that it will do so in the same way. So I think it's an internal need from people to know what's going to come next and to be in control of that. I totally get that. And if you're deep into your psyche and you feel that this is the emotion that you have, definitely something to explore. Definitely something to journal about, to talk about with your peers who are traders. But schematics are just guidelines. They just show us how possibly the structure could develop, but not necessarily how it will. So don't fall into that trap. Let's talk about the behavioral market analysis. Behavioral market analysis, and this is our Wyckoff Analytics definition, studies of market participants' behaviors in the context of a price structure. And again, we are coming back to our price cycle model. We're discussing strong hands against the weak hands. So what are the weak hands doing on the way down into the selling climax, into the stop in action? They are freaking out. They are emotionally compromised. They've been holding on to the losing position for some time. So as the market accelerates to the downside behind their selling and selling of other, let's say, even institutions, they are trying to get out of this position as they want emotional withdrawal from it altogether. That accumulates the number of sellers and creates a supply spike, which leads to the increased downward spread, increase of the numbers of gaps and the distance of the gaps, increase of the momentum to the downside. Behind that, on the other side, we have strong hands that are basically saying, okay, this is very interesting. I could buy a lot of stocks at a very attractive price. I'm going to start doing this. Why am I doing this? Well, because my predictive model, my analysis for this stock and for this group, industry group, and for the market in general, shows me that we're going to have some favorable market conditions that will lead this group to the outperformance and this particular stock to a leadership position. So I'm going to start buying. And as they start buying, they're increasing the emergence of the demand, as I stated before, increase of selling, increase of buying at the same time not only produces the stop in action behind the strong institutional hands, but also this produces a visible volume spike. And that's why we call that selling climax volume climactic. Climactic means to stop, to finish, right? To conclude something. What are we concluding? We are concluding a downtrend. We are not concluding an uptrend. In some cases, I've seen this labeling of the stop in action after the downtrend as the buying climax. And the logic was there, well, because institutions are buying, therefore it's a buying climax. What an incorrect assessment of the word climax, right? So buying climax, it's when buying concludes on the way up. That's it. There is no more buying, and therefore there is no more uptrend. Whereas in the downtrend, you will have your selling climax. Okay, so as this process happens throughout the trading range, weak hands are still selling, and then they start being discouraged throughout the trading range to even participate. So by the time that the emergence of the uptrend happens, there is an activity by weak hands. They completely emotionally withdraw, and the only people that are active are institutional trend adopters. As I mentioned before, those are going to be your hedge fund managers, registered investment advisors, and insurance companies, pension funds, and so on, so mutual funds. Their models are showing that there is an emergence of an uptrend and it's starting to outperform. So I need to get on this position because I know that the trend is going to last for some time. And also I see that the value investors have been buying heavily in this area. So that's what produces that initial push, that initial change of behavior. And then after that, other institutions are starting to join the party. And at some point of the trend, they stop buying. And public and other weaker institutional hands are starting to join. And this is an area, again, as I said, a very profitable area for everyone because the trend is established, the trend is advertised, the supply is in strong hands, the high probability continuation is to the upside. So a lot of people are making money at the same time. Very dangerous but exciting time for weak hands. And then during the distribution, we're going to see that the strong hands are going to start selling, and those selling is going to happen into the strength of the uptrend. As the price goes up, the value investors are selling into the strength of the price. Why? Because if they sell during the decline, they're going to influence the price movement too much. Instead, as they sell into the momentum of price going up, new highs, increased demand, their actions are just producing either temporary or more permanent stopping actions. And because of that, we start experiencing the preliminary supply events, we start experiencing the buying climax, and then once we see that supply starts overwhelm the buyers, then we produce a change of behavior, which is the reaction the largest reaction in the last leg up or in the whole uptrend. And that concludes the uptrend and switches the price environment into a non-trending environment. Let's look at this from a different perspective as well. What is the idealized market participation by strong institutional hands and by weak institutional hands, right? So here is strong hands. How would they behave through the whole cycle? As the price goes down, they see value, they see liquidity, so they're going to grab it. They're going to be buying as prices fall. And as the trading range unfolds, they still will be buying in the lower part of that trading range because, again, they're all about value at this point. Then on the way up, as the price starts to advertise the emergence of the new uptrend, the institutions will be buying because they are still relatively not far away from the lowest prices and from the value that they perceived in the future somewhere here. This is their target. So why wouldn't they be buying on the way up if there is so much left? Then they stop and they become inactive. They're just sitting on their profits. They do not present supply to the market unless there are some instances of the short-term overbought conditions or really attractive short-term oversold conditions to add to the position. And then they start selling on the behind the excitement of weak hands and in their value zone. And as they do that, as I said, first they temporarily stop the price movement, then they stop permanently, then they produce the change of behavior, and then throughout the trading range, that selling pressure increases until the price actually starts breaking down. And this is where they could be selling in the trading range as they sell over value, or they could be selling by capitulation, by their own capitulation. Doesn't mean that this is the last print in the reaction. They just initially start selling, and we could see this in a lot of breakdowns where there is a gap down, huge volume spike, and you instantly know that institutions getting rid of their positions. Okay, weak hands, how would they behave in the price cycle? They are selling by capitulation on the way down to the selling climax. They sell as the prices rally, as they don't believe that this is an accumulation. Then they are emotionally discouraged, so they become inactive in the first one half of the trend. And then once the trend is established and advertised, they start buying on the way up. And they have made enough money here to be encouraged to start buying during the distribution at the support level. And then after that, as the price starts going down, they hold on to this position. And that's why, because they're holding on to this position, once they come to the last part of the downtrend, this is where they're going to start capitulating. And then this price cycle repeats over and over and over again. Let's look at the examples of the price structures of the price cycle in different time frames. So this is Apple monthly chart, and we could see behind the volume signature that institutions were heavy buyers for almost a decade, if not more. How do we see this? I stated to you at the beginning of the session, at the top of the session, you will become a better chart readers after this course. This is one promise that I can give you. I'm not going to give you the promise that you're going to make money or you're going to improve even making money. It's all individual. It just depends. I mean, like, are you the beginner? Are you the advanced trader? You know, what's your kind of like a psychological landscape? I don't know. What are your skills? What is your knowledge? I have no idea. But I can promise you one thing. You will become such a good chart reader. You will understand where institutions have more presence and where they become completely inactive, and you will know how to behave in those situations. So see how easily we could see the volume signature increases, which are institutional buying, during the time when the price does what? Is this the best rally in this whole formation? Absolutely. So what are they doing then? They are buying. Okay, so this is one of the examples of buying, right? So we could have buying on the way down, buying on the way up, buying in, localized oversold conditions and so on and so forth. So a lot of case studies for us to study throughout the semester. But look what happens next. The market dictates that the leader, Apple at the time, is going to be taken down as well. We're going to look at the daily chart of that as well. We'll talk about that. There's a lot of supply. And then after that, is there any buying here? No, there is nothing there. So a higher low relative to the previous low with decreased selling, and then emergence of buying right here around this level. This is your point of entry. And on the way up, those are your add-ons, and you stay in the position. But we could see that institutions were doing what at that time as the price was going up? They were still buyers. Here's your answer to the question when you guys, for instance, look at the stock and the price has moved considerably off the bottom, and some of you don't really concentrate on the potential that comes next, that there is still so much room to go. Even if you didn't buy it at the bottom, you can still do this. So, and with that, I would be recommending you to look at those instances where you didn't buy and the stock continued doing well after your initial analysis. So just look into this. Okay, and then as we go after 2013, what happens? They're still buyers here, not so much, but what happens after that? They're not buyers anymore. They're not that active. Why? Well, because who wanted to load up? For the last 15 years, they have. And maybe there are some other leadership stocks of interest, like for instance, you start thinking about 2013, 14, 15, what comes to mind? Like 2015, maybe like a stock like NVIDIA started, its run, its big run. So there is some money migration there as well. All right, let's look at the weekly. This is the same Apple, 1996, 97. This is where Steve Jobs comes back to Apple right away, produces a lot of buying on the way down and then on the way up, and then more again on the way up. We see that from the volume signature. It's a very significant increase. The average volume has increased, and what does it produce? What is the result of that? I mean, obviously, an uptrending environment, higher highs, higher lows, overcoming the structure as a sign of strength and then a subsequent backup. So obviously, we would be interested as Wyckoffans to identify the points of entry for us, being those points of entry on the way up and throughout the structures, right? So something like this. In yellow, those are the points that we would consider being specific Wyckoff events or specific events as like a breakout or a breakdown. And those are the places where we would be thinking about opening the position. And then obviously, the price cycle concludes with what? With the distributional range and then with the downtrend. And the price cycle structure you could also find on the intraday level. This is Apple 2 hours, and we're seeing on the way down, there is increase in the volume signature. So buyers are buying, and then that buying diminishes the selling, and the price starts to improve. Higher lows, local higher highs, change of behavior, more testing, more absorption through the reaccumulation. And then as we come to this reaction right here, we start seeing some selling. And we start seeing some selling into the upthrust and then on the way down into the change of behavior. So everything repeats. There is really just a matter of, the concepts repeat. There are sellers, they dominate, the price goes down. There are buyers that see value, they start buying, that stops the downtrend. As they go through the trading range and they absorb the supply, the price is ready to start moving up. As we see the emergence of the uptrend, behind the sign of strength in the backup, because behind more buying, we establish the uptrend, and there is a continuation of it, and so on and so forth. But even though concepts repeat themselves, the variations on those concepts are just like so numerous, and that's where the problem lies. We can't, fathom remembering all of the possible variations, but we do remember the concepts. So we need to rely on the concepts of the dominant force and its effect in order for us to follow the price. Okay, let's talk about who are the price cycle market participants. So I've mentioned a value investor who is basically a contrarian investor. So Warren Buffett is such a great example of that. Composite operator is a great example of that. Those big companies like PIMCO, BlackRock, they base their entries on the value. Their size is huge. Their time horizon is secular to cyclical, which is in itself an edge. Because they look at the long-term trends, and they're looking for the long-term value. So if you sometimes might be thinking like, oh, okay, I didn't buy the bottom, so I don't want to buy the stock at 60 when it was at 40, but you're not thinking about the targets above 100. And that's how these guys think. They think so long-term, and they look for that short-term liquidity, to load up. So therefore, every time they do something, assuming that they are strong hands, we are seeing contrarian behavior, and that's why we would call the value investor a contrarian investor. They have limitations. They're too big, so they need to produce low turnover, especially if this is a money manager, and they have tax implications, less so now than before, but still some tax implications to consider. They are visible on charts by the extreme volume, by the points of liquidity, by the absolute and relative trends, and by long-term volume trends. Okay, second market participant is institutional trend follower. So I had to give it the name depicting that this institutional trader follows the value investor once the trend starts to emerge. And usually there's going to be a lot of growth narrative behind the institutional trend follower. Their size is big, their time horizon is cyclical. They look for the emergence of the trend, right? So, and that's the difference, not the long-term value, but the emergence of the trend or the break of the trend. And they still look for the long-term value and short-term liquidity because they still have a big size. Their limitations is that if this is a money manager of any sort, the performance matrix against their peers, against the market, against themselves of the past becomes very important. That drives the assets under management. They're still concerned about the low turnover of their portfolio as the client's requirements, and also some tax implications. Their edge, time horizon, right? So cyclical. There is more room to be incorrect and still be okay. Long-term trends, and obviously they have deep knowledge, as well as the deep knowledge, the contrarian investor has a deep knowledge. They are visible on charts from absolute and relative trends, long-term volume, and momentum buying and selling. It's institutions create momentum, not retail people. Retail people just don't have the size enough unless you're in COVID and you're Dave Portnoy, right? And you're creating like some kind of social herd to move the price. That was an interesting event to kind of like observe throughout COVID. Who are they? Examples: pension funds, insurance companies, investment banks, mutual funds, hedge funds, RIAs. Then we have professional traders. Those are usually momentum mean reversion traders. Their size is medium to small, daily swing, intraday timeframes. They are looking for short-term overbought, short-term oversold, and short-term momentum. Their limitations: they have too many trades, high commission, although this is going away. Short-term taxation is a big one, and then lower size. But their edge is definitely their quickness. They're visible on the chart around the momentum spots with the short-term volume increases, short-term liquidity increases, and short-term swings. They're usually proprietary traders, retail traders, and smaller sized RIAs. Retail trader, us, we are mostly driven by the momentum. Our size is usually small. We usually do the daily swing or intraday. Breakouts, point of excitements, are usually, those points that are going to excite the public. So we want to distinguish ourselves from that emotional excitement as much as possible and be more in our heads, kind of like, logical, always analyzing, calm, non-reactive. The limitations is sentiment driven. And this is a big one. How could you overcome the genetic conditioning of the past generations that is being given to you, and you have to trade by losing money? You have to make money. That doesn't really fall into the proper narrative of you being the provider and bringing food to the table at home, right? So it's so ingrained into us. So we need to know how to deal with that. Lower knowledge and lower skill. And again, I'm not want to put anyone down, but I just seen both sides. I've seen the institutional side. I have a lot of institutional money managers friends, and obviously I've had many conversations. I go to the conferences, I see the level of knowledge there, and relative to the retail traders, it's just immensely different. But the edge of the retail traders is quickness and different rules. You can create whatever rules you want as long as they're profitable. They're mostly not visible. Sometimes you could see the public in the areas of inactivity, but usually you don't, and that's definitely us. So these are the market participants and their intentions in the market. I want you to understand this, that different market participants will have different agendas based on their timeframes, based on their edge, what they want to achieve in the market, and how they want to do it. And if we understand that, then we could understand who's operating where. All right. Okay, let me just see where we are. 5:24. Okay. Yeah, we are almost done. So let's see where the weekends, trend followers, value investors, all of these market participants, where they actually operate. So we start with the contrarian investor, the CO. CO buys right here. This is where weekend selling, value buying, the CO buys in the lower range. Trend followers are still inactive because there is no trend. Then as we go into the emergence of the trend, weekends become inactive. They're just exhausted by these losses. Value still buying. They could be buying even on the way up as they see the value. And then now trend followers are buying. And because value is buying and trend followers are buying, demand is increasing. And because of the previous absorption and demand emergence, we're in a situation where the upward result starts to improve, and we start seeing, for instance, something like 52 weeks breakouts. Like, have you even thought about like why those happen? Or maybe momentum has increased, or the relative performance showing the leadership on the way up. Why do these things happen? I have a whole special just devoted to that single idea. What precedes price movement? Is that a relative strength improvement? Is that the momentum increase improvement? Is that the 52 weeks high? No, it's not all of those. These are the secondary effects of just one thing and one thing only. This buying has happened. They have committed the money at this point, and that's why the price started to move up. And that's why you see the 52 weeks high, increase of the momentum, and outperformance. Again, a very interesting topic, not something that we're going to talk about in today's session. during the distribution, weak hands are buying now. Value CO composite man, or the composite operator, selling, distributing, whereas the trend followers are still in this position, or they're still marginal buyers. Then as we go into the emergence of the downtrend, we're seeing weak hands are still buying, value investors already inactive, and trend followers are starting to see underperformance on the absolute and relative basis, at least during 2 quarters plus, and they start selling the lagging asset. And that's how we start seeing deterioration first, emergence of the downtrend, and then the breakdown. All right, let's go to the example. This is again daily chart of Apple. And the main thing here for us is to identify, those different market participants. So we see those volume spikes everywhere, right? They happen as the price goes down, goes down, goes down, goes down, goes down. But then what happens? What is the ultimate result of this trading range? What is the result of each time that the price goes down? It recovers. And then it recovers significantly up. And then in hindsight, we're seeing that indeed our suspicion that they were buying in this area materialized into the uptrend. Then we're seeing some momentum buyers, so trend followers emerge. And then in the next trading range, the same thing happens. It's on the way down that we see some buying by value investors. And then on the way up, we're seeing an increase in the volume signature. And this is institutional trend followers, momentum traders, even public come in and they start buying more aggressively. And that happens where? When we overcome the structure. Once we conclude the buying and the uptrend comes to some kind of decrease of the momentum, behind what? Behind this bar. What is this bar? This is the emergence of selling. It doesn't stop completely the price from moving up. It temporarily holds it, and it decreases the buying and that decreases the momentum to the upside. From there, once we are deteriorating and buying, the supply could emerge more even, and it could start moving the price down. And this is what we're seeing here as well. And this produces the largest change of behavior, suggesting the trading range. We go through the trading range, second point of selling on the way up, and then we see selling by the trend following hands. And again, this process just repeats over and over and over again. So, and we'll be studying that, of course. All right, this is it for today. 5:30, great timing, homework assignment, and mandatory assignment for those of you who signed up or who will be signing up. Read Jim Forte's Anatomy of a Trading Range. I'll talk about Jim. Unfortunately, Jim has passed away, I think a couple of years ago. He was a student in the class that I took back in 1995-96 at Golden Gate University. He was a brilliant mind. His the two biggest subjects were to talk about were Wyckoff and Elliott wave, and combination of those two. So please read this article. It's already on your student page, and we'll definitely discuss this. Okay, questions. Any questions? Let's see this. Okay, Paul is saying, thanks for the session, Raman. I will be signing up tomorrow. I'm sold. Well, I'm glad that you sold, but I also want to say that, there is a lot of work ahead if you're going to sign up. So definitely think about that, to which level of improvement you want to commit to, and if you're going to be there interacting, doing your homeworks, obviously that's going to produce the biggest progress. So I'm looking forward to working with you, Paul, and anyone else who wants to join. All right, any other questions? What is the reasonable amount of time to allocate to the study and homework each week? From Dominic. Really good question. So the first initial progress, Dominic, with your homework is going to be tedious. You might actually spend, if you're not familiar with Wyckoff methodology, you might spend around 2 hours on the homework. And in some instances, maybe even a little bit more. But with each homework, it's going to become easier and easier and easier. The key there is just not to give up and just to be very meticulously, meticulously careful in the way how you do the homework. Do not skip any parts. Make sure that you understand what you've read, and then always get the feedback from me. It could be in the next class where we're discussing the homework and we're discussing each of the charts. I will do that, or you're doing the self-review for some of the homeworks. We'll do that as well. So it's the way how you approach the homeworks that's gonna make such a huge difference in your studies. Lately, from Alonso, lately, I've been doing more short-term and scalping. Will this benefit me? Yes, Alonso, absolutely. So you might think that I'm discussing, the charts on the very, very long time frame and mostly stocks. To me, it doesn't really matter because the structure is the structure. The concepts of the dominant force changing from, let's say, selling to buying and back to selling is going to be the same regardless of the time frame. Even if you're scalping, with scalping, you definitely want to concentrate on a lot of momentum, but you also want to concentrate on where that momentum occurs, from which structural spot, and you still have to think about the bias there. And then on the short-term basis, let's say like if you're talking about the intraday trading, then absolutely, this is the material to do. So hopefully I'll see you in the class. Do you ever use tick chart in your intraday analysis, or do you stay with the time candles charts? I only go, the lowest time frame that I go is 1 minute. Sometimes when volatility is very high, so for instance, there could be 2 instances where I could change on my ES futures the time frame and make it below 1 minute, let's say 15 seconds. Never the tick data, it's too low for me. But for instance, when we have announcements from the Fed and the volatility is extreme, you can go lower, you can go to 15 seconds, and I would be okay with that. But you have to act as the momentum trader. You can't act as kind of like, it's a regular trading. It's a regular environment when the Fed reports or when, the rates are being changed. And also the second time when this could happen in the morning, the first 30 minutes, if we have a very volatile morning. So then you could use a lower time frame. But again, for me personally, I never go to tick data. All right, I think that's it. I don't see any other questions. There are some comments. Thank you guys for all of the thank yous. I'm looking forward to working with you. And if you have any questions, again, email us either at info@wyckoffanalytics.com or at wyckoffAssociates@gmail.com. Nancy will be happy to answer any questions. If this is the question related to the material, I will answer that. Otherwise, you're in very capable hands of Nancy, and she'll make sure that you receive all of the attention that you require. Thank you guys so much. Really great start for the session for all of you who are already students. So you're signing up tonight or tomorrow. Let's get to work, right? So this week, read the article. Let's discuss it next time. And then we're going to start discussing accumulation and distributional patterns. With that, thank you guys so much. And bye-bye until next Monday.